Welcome to Shaken Not Burned, a cocktail of solutions for a sustainable future. I'm Felicia Jackson.
And I am Giulia Bottaro. Each week we interview experts to talk about parts of the sustainable transition and what you and your business need to know to succeed.
Sustainability is complex and constantly evolving, and it can be hard for a business to adapt and remain competitive.
We are here to help you learn all about the changing economy and the ongoing transition.
So join us as we explore the concepts and the tools you need to plot a course for a sustainable future.
Welcome to another episode of Shaken Not Burned. It's a turbulent time for the global economy, which is leading some companies to roll back on their sustainability commitments and focus their efforts on what is deemed essential spending. However, environmental impacts go both ways. A company can create damage, for example, by polluting the air or water, but it can also be at the receiving end of this damage when ecosystem breakdown leads to flooding or wildfires, therefore increasing spending for that company. At this point, addressing climate risk becomes essential spending. But how can companies balance these challenges in times of economic crisis? I discussed this issue with Dave Jones, former California Insurance Commissioner and current Director of the Climate Risk Initiative at UC Berkeley School of Law. Thank you so much for joining us today, Dave.
It's wonderful to be with you.
Can you tell me a little bit about yourself? I mean, you've got such an impressive career. Maybe speak about what you are doing now at Berkeley and also what your role as the California's Insurance Commissioner entailed.
So I served from 2011 through 2018 as California's Insurance Commissioner, and in that capacity regulated the largest insurance market in the United States and about the fifth largest globally. The role is multifaceted. One of your responsibilities is to make sure that insurance companies remain solvent, that they're available to pay claims for businesses and individuals and families when they're needed. Another role is to regulate rates for property and casualty insurance. Another role is to administer a body of law to make sure that insurance companies treat consumers and businesses fairly in their interactions and fairly process claims. So it's a big job. The insurance industry is a big industry, not just in California, but throughout the United States and globally. It's a critically important industry and one that we rely upon in our individual lives, our family lives, our businesses as well. Now I'm at UC Berkeley School of Law at the Center for Law, Energy, and the Environment, which is a think tank, and I direct the Climate Risk Initiative there. And I do work around the intersection between climate change and climate risk and financial institutions and financial regulation. What should financial institutions be thinking about and doing as it relates to climate change and climate risk? What should real economy companies be thinking about and doing? And what should financial regulators be thinking about and doing as we face climate change globally and in the United States?
Sounds like a big job as well. Before we delve into the topic, can you explain in a nutshell what is climate risk and in terms of corporate life, how does it affect a company's operations?
So generally, climate risk to companies or corporations and financial institutions is understood to have two facets. One is the physical impacts of climate change, what you talked about in your introduction, increased flooding, increased hurricanes, wildfires, drought, extreme heat, severe convective storms. It's a long list of the ways in which climate change is physically impacting various geographies across the globe. And that has physical impacts on the operations of companies, their supply chains, their consumers. Really all facets of their business can be physically impacted by climate change. Then there's what's called transition risk, which is the financial risk associated with the transition that's necessary to address climate change. Here we're talking about the transition away from greenhouse gas emitting industries and in particular fossil fuels. That transition is driven by policy changes, by market changes, by technology, by consumer demand. That also poses a risk to companies as well. For example, that could have an impact on consumption of the product that the company is providing. Transition risk also can occur with regard to investments that a company might make. So if a company, particularly a financial institution like a bank or an insurance company, is lending into or investing in assets that we will be transitioning from as we transition away from fossil fuels and greenhouse gas emitting industries, then those assets could decline in value. Coal is an example of this in the United States. There's been a big transition away from coal as a source of energy and electricity production. As a result, some 35 or 36 coal companies have gone bankrupt. Lending to coal has declined, and coal as an asset that one would invest in has declined in value too. So that thinking about the risk that the transition from an economy that is largely fueled by fossil fuels and other greenhouse gas emitting industries to one that is not, that poses financial risks to companies and financial institutions too. So that's what's described as transition risk.
I suppose this will affect nearly every company that operates globally, because maybe they have managed to decouple themselves from fossil fuels, but certainly somebody in their supply chain will still be connected to fossil fuels in a way.
That's correct. And so the physical impact part impacts even those companies that have transitioned from reliance on fossil fuels or other greenhouse gas emitting industries, because the physical impacts of climate change are landing everywhere, killing people, injuring people, causing damage to property, and interfering with business operations. And so that's a risk that companies and financial institutions need to be thinking about as they think about their own investments in business operations. Transition risk is more about the potential risks associated with the transition. And if a company has already transitioned out of using fossil fuels, then yes, the risk to that company from the transition, at least in terms of its investments, is limited. But if other companies in its supply chain have not transitioned out of investments in fossil fuels, and that can have implications for those companies and those companies' availability to supply the primary company with goods and services.
I see. So overall, it sounds like these physical and transition risks that you were talking about are quite significant. But would you say that it's a standard corporate practice to include these considerations in strategic planning? And why? Yes or no? Why is it if it's a yes, and why if it's a no?
So I think that increasing numbers of real economy corporations and companies, as well as financial institutions, are thinking about, considering, and evaluating the risk that climate change poses to their businesses and operations. One of the primary ways in which they are doing this is through a disclosure and reporting instrument developed by the Task Force on Climate-Related Financial Disclosures back in 2017. So this basically is a framework that real economy companies and financial institutions can use to consider how climate change is impacting all facets of their operations. This framework also calls for the utilization of metrics to try to measure the impact of climate change and climate risk on operations as well. There's been some evolution in this reporting framework. It's now evolved and been basically taken up by the International Sustainability Standards Board, the ISSB, which has now taken over this framework and augmented it and actually issued a updated framework for companies and financial institutions to use to consider the impacts of climate change and climate risk on their operations and on their business. So many companies are using these frameworks, have done so voluntarily. What we're also beginning to see is that financial regulators and policymakers in various geographies across the United States and various countries, across the globe, are also requiring that companies and financial institutions disclose their climate risks. And then some nations and regional governance bodies like the EU are going beyond that and requiring that not only the companies and financial institutions think about the impact of climate change on their operations, but also think about and disclose their impact in furthering climate change through their business operations, principally through greenhouse gas emissions, but in other ways as well. And then some policymakers, like those in the EU, for example, have gone even further and set forth requirements that companies adopt and financial institutions adopt transition plans that indicate how they're going to transition from where they are today and their current contribution to climate change to net zero emissions so that they are not contributing further to climate change. So this is happening in various ways across the globe. I think the disclosure piece is critically important, that companies think about and disclose the risks that climate change poses to them, as well as what they potentially contribute to climate change. But beyond that, what's important is transition planning, figuring out how you're going to transition from where you are today to net zero so that your emissions are not contributing to climate change. Is it universally standard corporate practice? No, not every corporation, not every financial institution has taken up these approaches. And the degree to which financial regulators and policymakers are requiring it also varies. In the United States, for example, the Securities and Exchange Commission issued a rule after a very lengthy 3-year rulemaking process, issued a rule the other year requiring stock companies owned by shareholders, to evaluate and disclose the risks that climate change poses to them. Now, a new administration has come into power in Washington, D.C., and they've decided to abandon that disclosure requirement and, frankly, abandon any work around addressing climate change, as well as disclosure requirements that might exist for banks or for credit unions or for real economy companies. But even within the United States, it's more complex than that, because the state of California adopted 2 important laws in 2023. One, SB 253, which requires greenhouse gas emissions reporting, Scope 1, Scope 2, and Scope 3. And the second, SB 261, which requires Task Force on Climate-Related Financial Disclosure-aligned analysis and disclosure of climate risks. And those apply not just to companies incorporated in California, but to any large company doing business in California. So even though the federal government has begun to retreat from and actually undermine efforts to address climate change and to require climate risk disclosure and evaluation, big states like California are requiring it and are able to require companies and large financial institutions doing business in California to comply with it as well. So it's a complicated picture. I think that the short answer to your question is that it's increasingly a standard practice, but not for every company. It's increasingly required by regulators, but not every regulator. And it's something that every company and every financial institution should do, because climate change poses real risks to their company's operations. And that is for any company anywhere. Some of those risks are more acute. The physical impacts are worse in some areas than others. But generally speaking, there's no get out of climate change free card anywhere across the globe.
Absolutely. I was wondering, when you mentioned that jurisdictions such as the EU are asking that companies disclose their transition plans. However, it feels that in the recent months, we've heard a lot of companies rolling back on their commitments, or maybe delaying their targets by 10 years, which is a lot considering that action is already being delayed in general. So are they in breach of these laws? And what does it mean for general action in terms of climate?
Well, the bad news is that as companies and financial institutions retreat from commitments they made, it means that we're less likely to keep temperature rise below 2 degrees Celsius since pre-industrial period. We're already above 1.5 degrees Celsius increase. We're well on our way to 2 degrees, and we're likely, if things continue as they are, to get to 3 degrees, which has enormous implications, the climate scientists tell us, for even more severe and extreme weather-related events, sea level rise, a whole host of really bad things. So the pullback, the retreat, is not good. Unfortunately, we're also seeing some policymakers pull back as well. The EU, for example, even though it adopted the corporate sustainability due diligence directive and the corporate sustainability reporting directive, the last of which requires reporting of climate risks, the first of which requires making firm commitments to transition and adopting transition plans. Even the EU has begun to adopt regulations that would delay the imposition of those requirements. So the retreat that's occurring by corporates and financial institutions in many jurisdictions, sadly, is not in violation of the laws in those jurisdictions, although you better double check because there is some degree of variance in jurisdictions with regard to requirements. But even though that retreat may not be in violation of the laws or regulations in that country, it's a very bad thing in terms of our collective goal of trying to do everything we can to reduce greenhouse gas emissions and reduce global temperature rise, which in turn will help to at least deaccelerate climate change that's already baked into the climate system.
Yeah, and moving to insurance, which is your area of expertise, it feels that insurers are, can I say, the only ones that are really acknowledging what's going on. You know, they do it in a way that they stopped insuring certain areas that are particularly prone to hurricanes, wildfires, or flooding. But they are the ones that see the monumental financial damage coming from climate risk. Meanwhile, it feels that, as we mentioned, companies and to an extent, policymakers are, doing their best to ignore it or, try to delay action. So how can we address this disconnect?
So before I get to insurance, I do want to add that there are many civil society organizations, consumer organizations, and shareholders of companies, including major institutional investors like large pension plans for public employees, who are very, very concerned about the need of the companies they invest in and the financial institutions they invest in to disclose the risks that climate change poses to them and also adopt transition plans with firm commitments to transition to net zero. And so that's another important set of constituencies that companies should be paying attention to. If they're a stock company and they have shareholders, certainly they're going to want to be responsive to shareholders' concerns in this regard. Consumers are also making demands on companies, as are major institutional investors, like major pension funds that provide for retirement for public employees. They're also asking and demanding that companies and financial institutions adhere to these commitments and not retreat. With regard to insurance, it is the case that property and casualty insurers have a very real and deep understanding of the impacts of climate change because they're seeing it every year in increased losses they're paying out due to natural catastrophes. So the global insured natural catastrophe losses last year were about $154 billion. That's a record, and it substantially exceeds the 10-year average for global natural catastrophe insured losses. And the projections are that it's only going to go up. So insurers respond in two ways to increase losses. They increase price and they write less insurance. And we're seeing that in varying degrees of severity across the globe, depending upon how hard climate change is physically impacting that geography. And depending upon the degree of insurance in the geography, we're seeing insurers increase price and also simultaneously write less insurance. Unfortunately, I don't think we're going to rate increase or price increase our way out of this problem in the long run. Certainly, higher rates or higher price for insurance, both insurance for businesses as well as individuals and families, is one way to help insurers cover those losses. But what's happening in the background is that the risk of those losses driven by climate change is only getting worse. And that background risk driven by climate change is already in some areas outrunning the ability to increase prices in order to collect enough money to enable insurers to make a profit and keep writing insurance. And the state of Florida in the United States is one example of this, where the insurance rates are 4 times the national average. The state has set up taxpayer-funded nonprofit reinsurance to lower the reinsurance costs for insurers. They have eliminated third-party lawsuits against the insurers to help reduce costs to insurers. They have reduced the requirements for an insurer to actually begin insuring in the state of Florida by allowing insurers to be rated by a lesser tier, less rigorous rating agency. There's a whole long list of things. And yet, despite this, the major national insurance companies in the United States have completely pulled out of Florida. They won't write insurance in Florida. And the reason for that is, even at the highest price, they've concluded that the risk of extreme hurricanes in Florida, which is only growing, is so big that they can't afford and won't make a profit in that state. And that's happening in other states as well, not as much acuity yet or severity yet, but that's the direction of travel that we're on here in the United States, and I think elsewhere in the globe. So there are some things that can be done. One is, we've talked about, we need to transition faster from fossil fuels and greenhouse gas emitting industries, because that's the significant driver of the climate change that's causing these extreme and severe weather-related events that are causing insurance companies more losses. We also need to invest more in adaptation and resilience. And that includes both gray infrastructure to try to protect communities from the impacts of climate change, built infrastructure, say in the context of river flooding, think about levees, for example. But nature-based investments also can make a big difference too. So it turns out that replanting salt marshes along a coast can dramatically reduce the impact of storm surge. Having healthy coral reefs along a coast helps to reduce the impact of storm surge. Setting levees back along a river, which is good for the ecology. It means the river is able to meander more. That's good for the fish, for mammals, for birds, for plants, but that also reduces flood risk. More actively managing forests, using prescribed fire and thinning to reduce the fuel in the forest, not clear cutting, but reducing the volume of fuel in the forest makes the forest healthier, but also reduces wildfire risk. It's just a partial list of nature-based investments that make a difference. The problem, though, is that even though many countries and provinces and states and local governments and private companies and individuals are spending money on adaptation and resilience, in the United States at least, the insurance models, the computer models the insurers use to decide whether to write or renew insurance, don't take into account those adaptation and resilience investments. And that's very frustrating for people, because they can do all sorts of things to make their home more likely to survive or their business more likely to survive from a wildfire or a flood or hurricane or severe convective storm, but they get no credit for it in the decision the insurance company is making whether to write or renew insurance. So that can change. Laws can be passed to require the insurers to account for adaptation and resilience, and that would encourage more investment in adaptation and resilience and keep insurance written in more areas longer. So these are some of the things that can be done to help keep insurance available. But fundamentally, even those things are going to be outrun by background climate risk and climate change. Now, insurers are a tremendous source of information for private companies and for financial institutions with regard to these risks, how these risks are growing. And insurers do share that information and do have dialogue with their corporate customers on these issues. Not all insurers do this. More insurers need to do it, and companies need to insist they do it. But yes, insurers are really the climate change canary in the coal mine, and the canary is expiring, and that has implications for the rest of the real economy.
I have so many questions after this bit, but I will start with the first one. I'll try to start with one, which is, do you think that we basically need to change the entire insurance system as we know it?
So I think that we will get to a point in geographies across the globe where even at the highest prices, private insurers can't profitably write insurance. And so then we're going to need to look at public interventions to provide insurance. And so I think that the what one has to be careful about, though, is in constructing those public insurance programs, that they continue to be priced based on risk, that they not end up supplanting private insurance, but they only kick in where the private insurers have concluded they can't write insurance. In the United States, we have some bad examples of national public insurance schemes, like the National Flood Insurance Program, which was started about 40 or 50 years ago when private insurers decided they couldn't make money writing flood insurance anymore for homes and businesses. The National Flood Insurance Program, though, in the United States, the price has not been adjusted based on risk. So it's basically been subsidizing development, real estate development in areas of high flood risk because the price of the insurance is lower than it should be. It's also very regressive. People that are renters pay through their federal income taxes for flood insurance for homeowners. It requires $10 or $20 billion of federal taxpayer funding every 10 years or so to bail it out. So we have some examples of national schemes of insurance that don't work well, but there are other examples across the globe of ones that do. And I think that increasingly, as private insurers conclude that they can't write insurance and make a profit, we're going to have to look more to these national schemes of insurance. But I would be careful not to move too hastily, not to supplant the private insurance market. Although at the same time, as private insurance price goes up, that has real equity impacts because lower income households are less able to afford the insurance. Small businesses are less able to afford the insurance. So then you need to think about how do you create some premium subsidy mechanism that doesn't suppress the rate, which you want to be sending the right risk signal, but at the same time helps defray the cost of insurance so that lower income individuals or small businesses can afford it. And that would require some sort of public subsidy to do that.
I suppose my next question is whether insurance works more or less in the same way globally. Obviously, you focus on the United States, and that's what you've been mentioning so far. But is it a global problem, the insurance thing?
It is a global problem, although there are many emerging economies and developing countries where, because the income levels of the population are what they are, that private insurance is largely unavailable, maybe available in some limited ways or affordable in some limited ways for some portions of the population. But I think the problems I've described are not unique just to the United States. All developed countries that have robust insurance markets where property insurance is being written are experiencing these challenges based on the degree to which climate change is landing in their country. In emerging countries, sadly, where insurance is just not affordable based on the income levels of the population, then those populations and those business sectors are bearing directly the brunt of the impact of climate change without any kind of financial mechanism to assist them. Now, what some emerging countries have done, like Africa and in the Caribbean, is they've set up agreements between countries to create sovereign risk pools that then go out and purchase reinsurance. And so then that insurance is available to any one of those countries that participate in that pool to help it with the impact of climate-related disasters. And some of that money then can be made available to individuals, families, small businesses. Although the benefit of that oftentimes is really focused on disaster assistance as opposed to rebuilding one's business or home or farm. where people are oftentimes in emerging countries really left to their own devices because they don't have private insurance they can afford, and because even the sovereign insurance, it needs to go to deal with the immediate emergency impacts of the event. But having said that, these sovereign risk pools are also available to help people rebuild as well if the leadership of the country decides to use the money in that way.
Okay, so it's a more holistic approach in these areas as opposed to the underwriter and the insurance.
I think it's an approach that's been driven by necessity, because in emerging countries, private insurers have to charge more than what most people can afford and what most businesses can afford. So that makes the private insurance model very challenging in emerging economies in a way that it's not in other developed economies. So in emerging economies, what's developed are alternatives, which are more national schemes of insurance or multinational schemes of insurance, which are designed to try to help when major catastrophic disasters occur. So I don't know that I would describe it as holistic as much as it's been driven by necessity, because the income levels in many emerging economies are such that folks simply can't afford private insurers, and the private insurers have a difficult time pricing the insurance such that folks can afford it. Now, there are some exceptions. There's what's called microinsurance, which is a new product that's developing where a insurance company is willing to write insurance not to cover the entire loss that, say, a smallholder might have, a small farmer or a small rancher, say in South America or Africa, but instead will cover the cost of replacing the cattle or replacing the seed or making it possible to replant. So this microinsurance is a way of trying to create a more affordable, narrower insurance product to help small farmers and small businesses get back on their feet in emerging economies where the income levels are insufficient to be able to afford a full-blown property insurance and casualty insurance product. So that's another hopeful development, is this development of microinsurance in some of these emerging economies.
I understand. Back to the United States, when you were talking about the fact that a lot of Florida is uninsurable, are you aware of any companies choosing to do business elsewhere or moving their operations because they think it's too much of a financial risk to not be insured?
So that's a great question. So let me be clear about Florida. The national insurance companies are not writing insurance in Florida, but Florida-based and regionally based insurers are. But what happens is they write insurance for a few years, a big hurricane hits, and then they go insolvent because they're not adequately capitalized. Yes, we're seeing in at least 18 states in the United States, insurers increasingly not renewing insurance. They may not be leaving entirely. In fact, in few states are they leaving entirely other than Florida, the national carriers, but they will not renew existing customers and they'll stop writing new customers. And that's happening in California. So the areas of California where there are high wildfire risks, the forested areas and chaparral lands, what private insurers have increasingly done, even though they were writing insurance there, is not renew the annual insurance contract. And then in addition, last year and the year before, for the first time, private insurers said, we're not writing new customers. We'll renew 85, 90% of our customers that are outside the forested areas. In the forested areas, we're going to more aggressively not renew them. But if you're buying a home for the first time anywhere, or you're moving from home A to home B, we're not going to insure you. You're a new customer. And so that's an example of how insurers, short of leaving the state entirely, are reducing their exposure to losses by reducing the amount of insurance they're writing.
Okay. And you mentioned a while ago the concept of using nature-based solutions as a way to limit damage. And the Climate Risk Initiative has launched a wildfire resilience insurance policy, which I believe is a first of its kind policy that does include the use of nature-based solutions. So could you expand a little bit on this?
Yes, thank you for asking. So one of the goals of our climate risk initiative at UC Berkeley Law School is to get insurers to account for nature-based approaches to reducing risk. One of those approaches in the western forests of the United States is managing the forest the way nature used to manage our forests before Western settlement. Before Western settlement in the United States, fire was a routine part of the ecology of our forests. The fire would burn through, it would burn out the smaller trees, it would burn out all the low-lying vegetation. And so our forests were characterized by a lot more open space and were less likely to end up burning in a major catastrophic wildfire where the fire gets up into the crowns of the trees and you have a huge disaster. Then we had Western settlement, and fire was suppressed in the Western forests. There used to be Native American peoples in the Western forests that would engage in cultural burning to manage the land. Well, many of those individuals were killed and were removed from the land through genocide against Native American peoples in this country. So we've had about 170 years of suppressing fire. Well, as a result, our forests have become choked with fuel. And that fuel, as temperatures rise and things get drier, becomes a big driver for major catastrophic wildfires in a way that we haven't seen before. So in the last 10, 15 years in California, we've had 15 of the 20 most catastrophic wildfires occurring just within that recent period of time. So what can we do to address that? You can mimic the way that nature used to manage the forest by reintroducing fire to the forest in a controlled way, what's called prescribed fire, that burns out the low-lying vegetation and the smaller trees. You can also thin the forest, not clear-cut it, but thin it, remove the smaller trees, which function like ladders to allow the fire to get up into the crowns of the taller trees. If you remove the smaller trees, you reduce that phenomenon. So the state of California has appropriated $3.6 billion for this sort of forest management. Local cities and towns are doing it. The federal government is spending money on it. And yet, until very recently, we had no example of an insurance product that actually was accounting for all of these investments in this nature-based approach to reducing wildfire risk. Well, we're excited to announce just the other week that we have, working with a global insurer and a global risk advisory firm, Willis Towers Watson, have written the first insurance policy that's written based on the fact that the large community for which it's written is undertaking this kind of forest treatment that I described a moment ago. And even though this is an area where many insurers are not renewing insurance and are not writing new insurance, we were able to persuade an insurance company to write insurance for this community because it was undertaking forest treatment. And the insurance is 39% less in cost than what it would be, and the deductible is 84% less than what it would be because of the forest treatment. So we're excited about this because we wanted to demonstrate that this could be done, that an insurer could and would write insurance taking into account forest treatment. And our goal then is to try to convince more insurers to do this for more customers in areas where forest treatment is occurring, and then also encourage more public and private investments in forest treatment. So that's one example. Another example is in the river flooding context, where there are nature-based approaches to reducing river flooding, including levee setbacks. So I'm working on another project in the Midwest to see if we can place an insurance product that takes into account the reduction in flood risk, because we're doing a nature-based flood risk reduction approach, which includes setting the levees back so that the river is healthier, meanders more, there's more room for fish, birds, mammals, plants, but it also reduces flood risk. So we're trying to get an insurance policy written that accounts for that. So these are examples of this sort of approach. And I think it's exciting that we've placed the first ever wildfire resilience insurance product that directly accounts for this. And now we need to persuade more insurers to do this as well.
Well, hopefully this one will serve as a good example, and many more insurance will see that it can work really well. I think my final question here is, going back to my introduction, it's a difficult time for companies, lots of rowing back on sustainability commitments, but there's no way of ignoring climate risk. So how can a company prioritize this amid all the other challenges that they're facing?
So I understand that we're at a moment in terms of our global economics because of decisions by the new administration in Washington, where there are all sorts of disruptions occurring in economies across the globe because of decisions that are being made in Washington. I'm speaking specifically of tariffs, but not exclusively so. So companies have real challenges now across the globe in trying to figure out, what are the new economic rules, and on top of that, they're facing impacts in many geographies from climate change. I think it's still important to make it a priority to spend some effort and resources in figuring out how climate change poses risks to your company or to your financial institution, and then figure out what can you do meaningfully to reduce your company, your financial institution's impact in terms of contributing to climate change. And while it's not free to do this, the costs of these sorts of analyses are not inordinate, but they're very important, both in terms of reducing risks to the company and the financial institution itself, and better understanding what risks the supply chains are facing in order to maintain the sustainability of the company over time and the financial institution over time. So it should still be something that companies and financial institutions do, even if policymakers and regulators are retreating, or even if some companies are retreating. Many are not, and hopefully more will continue to look at what risk climate change poses, disclose those risks, and do something about it.
So invest now, but this will save money in the future. Thank you so much, Dave, for this amazing conversation. And thanks to our listeners for following us. We are on all social media. We also have a free newsletter, so don't forget to sign up. Thanks again, and see you next time.